All right, ladies and gentlemen, we have about 1 minute before our official start time, so we're going to start in about 60 seconds. We like to start on time and try to end on time, but we do want to make sure we give everybody room to log in and get registered. So just hang tight for a few more seconds and we'll start shortly. All right, ladies and gentlemen, it is time to get started with today's 1031 Exchange webinar. My name is Leonard Spoto, and this is me. I'm going to be your host today for today's presentation. Our company does a bunch of webinars throughout the month, and today's webinar is actually one of my favorites. It's called 1031 Exchange Problems and Pitfalls. So what we do today, as the name implies, is we talk about all the things that could go wrong in a 1031 exchange and how to avoid them. Now, in today's class, we are going to make the assumption that you have a basic understanding of how the 1031 exchange process works. If that is not the case and you are a complete newbie, today's 1031 exchange presentation might not be for you. Now, we do have at the beginning of September a few 1031 exchange basic programs that we're offering, and we do have a lot of our 1031 exchange basic webinars recorded on our YouTube channel. So if you need the basics, please do join us for one of those classes or go to our YouTube channel and I can send that over to you. But today's class is, as I mentioned, problems and pitfalls. So we talk about what can go wrong. We talk about some nightmare scenarios. We talk about some really kind of funky issues that could mess up your 1031 exchange and result in a tax bill. So as I mentioned, really like this class because it gives us a chance to showcase some of the oddities in the 1031 exchange world and what the auditors, the IRS, looks for when auditing a 1031 exchange transaction. So again, my name is Leonard Spoto and I'm going to be your host for today's presentation. Before we get started, I do want to make a couple announcements. Announcement number one, everybody who's on today's presentation is going to get a copy of all of the presentation slides emailed over to you. So keep an eye out for that. That should go out later this afternoon. And then the other thing I do want to mention is that if you have a question or a comment that you want to make, please do send it over to me. I look forward to answering all your questions, and I want to make sure that we don't end the presentation until everybody has all of their questions answered. So the way that you get the way that you get a question over to me is you type it in. Okay, on your control panel for the webinar, there is a little dialog box that's called questions. Just open it up, type your question in, and it will pop up. And I will answer those questions as they are appropriate. All right? So how's everybody doing today? The real estate market has come back very strong, even though we're in a work from home, social distance, and homeschooling situation, right? So we've got a lot of challenges in society right now. We can't get too close to each other. Our kids are driving us crazy because we're having to teach them. And the good news is that the real estate market, although here in California, we had a really slow 3 months, April, May, and June. July and August have been fantastic so far. So I hope you guys are doing well and staying safe and also staying really busy with your real estate deals. So that's the good news. Let's kind of just jump into it, ladies and gentlemen. So this is the only overview I'm going to talk about, all right? Everything else is going to be kind of problems and pitfalls. But let's talk about what 1031 is. Section 1031, it's the greatest wealth building tool available to real estate investors. It really is. Okay, Section 1031 of the Internal Revenue Code allows you to defer the capital gains taxes on the sale of your investment or business use property. Now, my clients will routinely defer hundreds of thousands of dollars in potential tax liability by doing a 1031 exchange. So Section 1031 is a gift from the government to all investment and business property owners. It allows you to sell your highly appreciated property and not pay taxes. Okay, you get to defer that tax bill until you eventually stop exchanging and cash out. So as I mentioned, I have clients who routinely defer hundreds of thousands of dollars in potential tax liability by doing a 1031. All right, that is a high-level overview of what 1031 is. Now, let's talk about some problems and pitfalls. By far and away, the single greatest problem that a 1031 exchange client will have is this. Take a look at your computer screen. The inability to find suitable replacement property, right? Section 1031 of the Internal Revenue Code allows you to defer the taxes on your investment sale or business property sale, but you have to do what? You have to go out and buy replacement property. And ladies and gentlemen, in today's market, the single greatest problem that my clients face is finding suitable replacement property to buy. All right, so if you are a real estate agent and you're working with a seller who is considering doing a 1031 exchange, the first thing you should do is call me to set up an exchange account. But the second thing you need to do is you need to start scouring the market for what they might want to buy. You need to do your due diligence and you need to start making offers. All right? Because if you can't find suitable replacement property and you can't close, you do not have an exchange and you pay taxes. So ladies and gentlemen, do not hesitate. Get out there, start looking for replacement property. Now, everybody on this call should know that when you do a 1031 exchange, you have a time frame, right? You have 180 days to buy replacement property, and you have to identify what you're thinking about buying on day 45. Now, your time frame starts when you close escrow on your sale, right? So the close of escrow starts your time frame. Now, that doesn't mean you have to wait until the close of escrow to start making offers. Most of you are going to get into contract to sell the property and have a 30-day escrow period. Now, if you want, you can go out in this period here and start looking for and making offers on replacement property. That is a very good strategy. Do not wait until here to make offers on properties. By God, don't get too far in your exchange to start making offers, because if you do that, your chances of success are going to dwindle. People who do have a successful exchange are usually in contract on their replacement property in this sweet spot here. All right. So the single biggest advice I have for all of my clients when they say, well, geez, Leonard, what should I really look out for? Well, the thing about the exchanges is they don't happen unless you find replacement property to buy. So my greatest piece of advice is go out, understand the market, understand where you want to buy, what type of asset, and don't hesitate. Now, Jennifer says she can't hear me. I'm guessing Jennifer has a problem with her computer. So can anyone else tell me if, or actually, if you can let me know if you can hear me, that'd be great. Yep, other people can hear me. So if you can't hear me, turn your audio speakers. Okay, I'm going to tell Jennifer to turn her audio speaker on. Thank you, everybody else, for letting me know you can hear me. There's always someone who can't figure out their computer, and it's usually not her fault. Maybe her kids messed with her settings, right? All right, the other thing I want to talk about in terms of this is have a backup plan. All right, so if your first choice is a 4-unit building in Los Angeles and you get overbid by 20 other buyers, well, you're going to miss out on your exchange if that's your only option. So I always tell people, when you go into a 1031 exchange, I want you to have a backup plan. Is there another type of asset that you can look at? Maybe instead of an apartment building, what about an office building? Is there another geography you can go into? So it's very good. The first thing you want to do when you're considering an exchange is understand the market, figure out what you want to buy, but also have a backup plan. All right? So all right, so Jennifer just can't hear me. I'm sorry, Jennifer. Now, Robert wants to know, well, geez, is there any extensions because of COVID-19? Don't we get more than 180 days? The answer to that, ladies and gentlemen, is no. Unfortunately, the government did provide an extension, but it expired on July 15th. So they did not provide any additional relief. So if you're thinking about doing an exchange now and you're hoping that you're going to get more time because of the COVID-19 thing that we're in, the answer is no. You still only have 180 days, all right? So the biggest piece of advice I can give you right now is start planning, do your homework, and that will increase your chance for a successful 1031 exchange, all right? So let's go ahead and move on. Other things that happen that screw up people's exchanges, and this actually happens all the time. I get people who call my office and say, hey, Leonard, I closed escrow last week. Can I do an exchange? And the answer is no, you can't. You need to get your exchange account set up before you close escrow. So let's take a look at a recent example based on a conversation I had with a client. The client opened escrow on a $700,000 rental property. The client told the escrow officer, hey, I want to do an exchange. The client assumed the escrow officer was going to set up the exchange account for him. Ladies and gentlemen, you know what happens when you assume. You make an ass out of you and me, right? Escrow closed on Friday. The deed recorded. The funds were dispersed to the client. The 1031 exchange account was not set up. Client owes taxes. If you plan on doing a 1031 exchange, you have to get an accommodator lined up prior to the close of escrow. The easiest way to do that, ladies and gentlemen, is to pick up the phone and give us a call. We will coordinate directly with your escrow company and get all the documents we need and prepare the account. Now, your escrow company cannot be the accommodator. Now, they may have an escrow partner like us. We are partners with many escrow companies, but the escrow company can't do it. There has to be a neutral third party that facilitates the process, and that's what we do. All right? So very importantly, any time before the close of escrow, you can get your exchange account. But if you've closed and you call me the next day, you're out of luck. You're paying taxes. So don't let that happen to your client. Get everything lined up as soon as possible. There is no fee until you close escrow. So if you opened up escrow today, get the exchange account set up. If the buyer backs out, we don't charge. All right? So the only risk is on me. I waste my time and my staff's time getting things prepared. If you don't close, I don't charge you. All right? So don't be caught off guard. Get your exchange account set up prior to the close. All right, what else can happen to screw up an exchange? This is a big one, ladies and gentlemen. This is a big one. Improper use of your 1031 exchange property. In fact, this is such a big deal that people go to jail for improper use and tax fraud related to their 1031 exchange. All right, let's take a look at this press release. This press release was from, it's an old one now, it's from 7 years ago, but it's a good one. There was an agent in Salinas, California, who served 14 months in jail for tax fraud, tax evasion, because she did her 1031 exchange wrong and used her replacement property incorrectly. Now let's go over the set of circumstances that led Cheryl Savage to spend 14 months in jail. Cheryl sold a rental property, and it was a legitimate rental property. She bought a single family property, a home, and you can do that in a 1031, right? You can buy a home, but if it's a 1031 exchange purchase, what do you need to do? You need to rent it out, right? Well, Cheryl did not do that. She moved into the property, and then she falsified her tax returns to make it look like she was receiving rental income. She wasn't, okay? She didn't have a tenant in the property. She lived there on her own, and she just falsified her tax returns to make it look like she was getting rent. The government audited her, and they found her guilty of tax fraud. They made her pay her taxes. They had her pay a fine and interest. But I mean, this lady, unfortunately, spent 14 months in jail because she moved into her 1031 exchange property right away. Okay, that, ladies and gentlemen, is something that I want you to avoid. And believe it or not, people call me all the time asking me how to do this. They say, well, geez, Leonard, what I really want to do is I want to buy a home to live in my 1031 exchange. And I say, well, that doesn't work. And they say, well, what if I just pretend like I'm renting it out? I'll have my brother sign a lease agreement, and he'll just throw me some money, and I'll just say that's my tenant, but I'll really live there. Ladies and gentlemen, that's tax fraud, okay? And tax fraud gets you 14 months in jail. So what do you need to do? Well, when you buy your 1031 exchange property, you need to rent it out to a legitimate tenant for at least 2 years. You want to have your lease agreement with your legitimate tenant saved, and you want to report all of the legitimate rent on your taxes, and you want to do it for at least 2 years. Once you've established that property that you bought in a 1031 as a 1031 property by renting it out for 2 years, you can then kick the tenant out and you can move in, but you have to rent it out for at least 2 years before you do anything with it personally. All right? I don't care what your brother's uncle's best friend's friend told you, where he said, oh, you don't have to do it for 2 years. Okay, I've been doing this in California for 20 years, and the auditors in California want to see 2 years, especially if you are now living in the property. All right, because you have to have a bona fide, legitimate investment intent with that property if you bought it as a 1031. And if you rented it out for 8 months and then moved in, they're going to challenge the investment intent. After 2 years, you're going to be okay. That's a defendable time period. But anything less than 2 years is really hard to defend with the auditors. Now, April says, well, I'm in Nevada. Do I have to wait 2 years? You know what? I'm going to be honest with you, April, probably not. Because Nevada, you guys don't have a franchise tax board that audits. And the IRS at the federal level is probably not going to audit you. So if you want to do less in a different state like Nevada or Florida or Texas, where there's really no oversight on these things, go for it. Okay, but here in California, you can go to jail if you're too loosey-goosey. All right, so just be careful. All right, you don't have to follow the rules. You don't have to follow my advice, but if you don't and you're in California, you just might end up in tax court, or at the worst case, you might end up in jail. All right, so just be careful. All right, what else we got here? I'm looking at your questions too, and Steve wants to know, well, geez, what about hardships? What if I rented the property out for a year and a half and my tenant moved out? I tried to re-rent it, but I couldn't. I lost my job. I lost my primary residence, so I had to move into my rental. Well, the government's going to take all those factors into consideration. But Steve, they have to be legitimate, and you have to be able to document and prove all of those things. All right. So there's always extenuating circumstances, but in most situations, I want to see 2 years. All right. All right. Let's move on to some other harrowing things that you want to avoid. Here's another thing: related parties. If you are doing in a 1031 exchange anything with a family member, pick up the phone and call me. All right? Because anytime you do something with a family member, I'm going to need to let you know whether it's legitimate or not. All right? So put my phone number, I'm going to try again, into your cell phone right now, because you're going to have a client that's going to say, hey, I want to do this exchange and I'm going to have my kid involved. Okay, big red flag. What's the kid going to do? If the kid's going to live there in the exchange property, that's fine, as long as he or she is 18 years or older and paying legitimate fair market value rent. So can you rent your 1031 exchange property to a family member? Absolutely. But it needs to be a legitimate rent. You can't charge your son $1 a month when fair market value is $2,000 a month. Can you charge him $1,800? Yeah, probably. Can you charge him $1,500? I don't know about that. Okay? If you are going to do a 1031 exchange or have a related party involved in any capacity in your 1031 exchange, pick up the phone and call me. Now, ladies and gentlemen, what is a related party? Well, it's a family member, right? So any member of the same family, siblings, spouses, ancestors, lineal descendants, all right? But a related party can also be a corporation that you control. So if you own 50% or more of an entity, a corporation, an LLC, guess what? That's a related party. And the government wants to know when you do deals with related parties. In fact, the form that you file to report your 1031 exchange to defer your taxes asks you, was this a related party transaction? And if you don't check the box, and it was, well, that's tax fraud. And if you do check the box, guess what? You're going to be at an increased chance of being audited. So if you are going to do any type of related party transaction, you have to follow the rules. So here are the rules. Number one, yes, you can rent your property to a related party if it is legitimate rent. All right. So you can rent it to your daughter. You buy a 1031 exchange property in Arizona and your son goes to U of A. You can rent the property to him and his buddies, but they need to pay you fair market value rent. Now, the other thing is, can you buy and sell 1031 exchange properties with family members? It depends. All right. You can only buy your 1031 exchange property from a related party if that person is doing an exchange. Now, here is the most common question I get regarding related parties, okay? My client's going to sell a rental, and he's going to sell it for $1 million. He wants to buy mom's primary residence because mom's 80 years old now. So he says, you know what? I'll do a 1031 exchange. I'll sell my rental, and I'll buy my mom's primary residence. Now, ladies and gentlemen, is that allowable? Well, let's look at the rule. Can you buy from a related party? Well, yes, you can, but only if that person, mom, is doing her own exchange. And guess what, ladies and gentlemen? You cannot do an exchange on a primary residence. So this transaction is not allowed. Let's take a look at a different scenario. Okay, my client's going to sell his rental, and he wants to buy a property from mom, and mom was renting the property out. Okay, can I sell my rental and buy a property from my mom that my mom was using as a rental? Absolutely, as long as mom does her own 1031. If she doesn't want to do a 1031, then this whole deal doesn't work. You guys get that? The government doesn't like it when you use 1031 dollars to buy something from a family member and that family member cashes out. All right? Because you might be deferring a ton of taxes and they might cash out and pay no taxes. And all the money stays in the family. So they don't like that. They only allow you to buy replacement property in an exchange if that person is also doing an exchange. Okay, that's the first scenario. Let's look at another scenario where a related party issue might come up. Can you sell your 1031 property to a related party? Yeah, you can, right? So I'm going to do an exchange. I'm going to sell my rental, and I'm going to go out and do a 1031. But my brother, he wants to buy this property. Okay, so we're going to sell this property for $1 million to my brother. We're going to take the money and we're going to go out and do our own 1031. We're going to buy from someone we don't know. Does that work? Absolutely. But guess what? Brother has to own the property for 2 years. If he turns around and flips it, that doesn't work. All right? So very important. This is what I want you to do to remember. I want you to remember anytime your clients think about doing related party deals that involve 1031s, pick up the phone and hit your speed dial. Because you're going to have my number in that phone, right? So get me on speed dial, call me and say, hey, my brother, he wants to do an exchange with me. Is that going to work? Well, it depends. Let's go through the facts and circumstances, all right? So Sergio wants to know, well, does the brother have to pay market price? Well, geez, you're selling $1 million property to your brother, right? And if he pays you $700,000, that might be a disguised gift. And the IRS might have a problem with that. So you want to sell the property to your brother at close to fair market value. Now, if it's $900,000, right, is it going to be caught by the IRS? Probably not. But if it was $300,000 and the property's really worth $1 million, that's going to be a problem. All right. It's really hard to kind of assess the fair market value on real estate unless it's really obnoxious, right? I mean, if you got $1 million property and you sell it to your brother for $100,000, the government's going to pick that up. But if it's $800,000, $900,000, I mean, it's going to be tough for them to know. All right, but good question, Sergio. All right, let's look at other things, okay? Other issues that come up in 1031 exchanges. This is a big one. People don't realize this. When you do an exchange, the taxpayer who sells the property must be the same taxpayer who buys. Now, normally this is never an issue because Bob, he's going to sell a property. His name's on title. Bob does a 1031, and Bob goes on title, and Bob buys the replacement property. So Bob is his own taxpayer. He's sold. He's on title. Bob does an exchange. Bob puts the new property in his name, and usually there's no issues. Where there can be issues is when you have LLCs and trusts involved. Because, ladies and gentlemen, an LLC or a trust can become their own taxpayer. All right? A multi-member LLC that has multiple members that are not husband and wife. So you got Bob over here as a member, and then you've got Fred. They're just buddies. Okay? They like to buy property, though, together because they're good friends and business partners. So Bob and Fred, they formed an LLC. It is a multi-member LLC, so it is its own taxpayer. And if that LLC wants to do an exchange and sell a property, guess what? The LLC is doing the exchange, not Bob and Fred. They don't own real estate. They own shares of the LLC. So when that LLC sells property, the LLC is the taxpayer to do the exchange, and that LLC needs to buy the replacement property. So we need to know who your taxpayer is. And I'm always going to pull the title report when you set up an exchange account with me, because you might be working with Bob. And Bob says, yeah, I own this property. So I pull the title report and I say, hey, whoa, Bob doesn't own the property. There's an LLC on title. Who owns the LLC? Oh, well, he's got a partner, Fred. Well, geez, we've got an issue now. Do Fred and Bob want to do the exchange together and buy the new property under the LLC? Or does Bob want to go off and do his own exchange, and Fred, he wants to do something completely different and go out and buy a boat with his money? If that's the case, you've got problems. All right? If Fred wants to do something like buy a boat, you need to get the property out of the LLC and put it in the individual names so that Bob is on title as his own taxpayer, Fred is on title as his own taxpayer. Fred could go and buy his boat with his money, and then Bob can go and do his 1031. All right? So the taxpayer who is on title is very important. Let me give you another issue that comes up around trusts. What happens is smart people, mom and pops, they will put their property in a trust. And the reason why they do it is because when they die, they want the government to stay out of their business, and they want their kids to be able to inherit their property without going through probate court. All right? So they're going to put the property in the trust so that when they kick the bucket, the kids can inherit the property without going through probate. It's a very good thing to do. You all should do it. The problem is when mom and dad die, this trust becomes irrevocable, meaning the kids can't change it, right? You don't want little Jimmy to go out and change the trust after mom and dad die to get Susie, his sister, off of all the inheritance, right? So the trust becomes irrevocable. And ladies and gentlemen, an irrevocable trust is its own taxpayer. The trust will now start filing its own tax return when mom and dad die. So kids hold the property for 5 more years, and it's been a great rental. It's an apartment building. The kids have been living off the income. But now they say, you know what? We got to sell the property. Okay. Well, who's the seller? Who's going to sell this property? Is it little Jimmy and little Susie, or is it the trust? Well, the trust is selling. So if little Jimmy and Susie want to do an exchange, who does the exchange? The trust, not Jimmy and Susie. Now, Jimmy and Susie can do an exchange, but they got to take the property out of the trust and put the title in their own name. So we always want to know who the taxpayer is that owns the property. Now, something else comes up, and I just had this last week. I had a lady call me. Let's call her Sue. Sue bought a property, but her brother went out and got the loan because Sue couldn't qualify. And ladies and gentlemen, I hate when this happens. This is really, really annoying. Try not to do this, okay? Sue goes on title to the property. The brother gets the loan, so the lender wants the brother on title too. But the brother's not really an owner. He's just helping Sue buy this rental. But guess what? He's on title. And now Sue wants to sell it. The brother's on the loan. And she calls me up and says, Leonard, what do I do? I said, well, clean up your act. Get the brother off the title. Pay off the loan. Get the brother completely out of the situation. And then do your own sale and do your own 1031. And then she says to me, well, geez, but I can't qualify for the loan on the new property. Ugh. These are terrible situations. You got to keep your brother on then. Your brother's tied into this deal forever until you can get your situation cleared up and you can do your own financing. Now, April has a question. April says, well, geez, what about all this stuff? Is it the same for Nevada? Absolutely. Okay. LLCs, trusts, all this stuff, all these taxpayer issues are the same all over the country. Let me tell you one other thing, because this is important. You can have an LLC that is disregarded, meaning it does not have its own taxpayer ID number, but only if there is one member or you have a husband and wife as the only members. And what will happen is this LLC, if there is only one member, or if the only members are, what are they called, married couples, you can choose to disregard the LLC for tax purposes. It will not file a tax return, and everything flows down to the actual husband and wife or the one member. All right, so LLCs and corporations and all those things, when you see those on title to the property that you are listing for your client, I want you to remember that that's an issue and use the speed dial number on your cell phone for your 1031 guy. All right? All right. Same taxpayer requirements, very important. Now, here is another big issue. In my industry, there is a term called boot. And boot, when it relates to 1031 exchange, is something that is taxable. And most of you are going to want to avoid boot. Most of you, when you do your exchanges, don't want to pay taxes. All right? So here's how we do it. Let's go through a set of circumstances. You are going to sell a property for $500,000. And for 1031 exchange purposes, I'm always talking about the net sale price. So you might be in contract for $550, but the way I got this number, ladies and gentlemen, is I've subtracted out your commissions and closing costs. You can always, for 1031 purposes, take out your commission and closing costs when you're figuring out what your net sale price is. All right, so that's the number we're always going to work with, your net sale price after commission and closing costs. All right, so in my example here, I have a net sale price of $500,000. I have a $200,000 loan on this property that's being sold, so that means I have how much equity? It's right there, $300,000, right? Equity is the cash you have in your property once you pay off your debt. So when you do an exchange, what do you have to do? You have to purchase property equal or greater in value. All right? Everybody knows that. What they don't know is that you also have to reinvest all of your cash. All right? So all of your cash needs to be a down payment on the property that you're buying. Any cash you do not reinvest is going to be considered boot and taxable. So guess what happens, ladies and gentlemen? That causes problems. People work with mortgage brokers or lenders who don't know the 1031 rules, and they say, hey, the rates are really, really good right now. Just put as little down as you can. So instead of putting $300,000 down, you end up putting $100,000 down to buy your $500,000 property. And in a 1031 exchange, that causes a problem because you have $200,000 of cash that's left over. And again, we call that boot. And if you do not go out and use that money to buy another property, guess what? You've got a $66,000 tax bill. Ladies and gentlemen, when you do a 1031 exchange, you have to reinvest all of your cash and purchase property equal or greater in value. In this example, my client bought property for equal or greater in value, but they failed to reinvest all their cash, and that results in a tax bill. They have to write a check to the government for about $66,000. That's a problem, right? So you want to make sure that you understand the rules. Let's talk about another situation, all right? Same set of circumstances. You sell a property for $500,000. You have cash equity in that property of $300,000. And your client says, well, geez, I want to go out and buy a $300,000 property with all my cash. That doesn't work. Now, what you did was you spent all your cash, but you didn't buy enough real estate. So you traded down in value. The technical term here for our boot is actually debt relief because we didn't replace our debt. So what does that mean? Well, when we trade down in value and we don't replace our debt, we have debt relief, which is taxable, and your client has to write a check to the government for $66,000. That's fine if you want to do it, right? Some of my clients are okay with doing partial exchanges and paying some tax, but you got to be mindful of the rules because a lot of people go into this thinking, well, geez, all they have to do is reinvest the cash or the profit. I have people tell me all the time, well, geez, Leonard, my profit is only $100,000. So all I'm going to do is buy $100,000 worth of real estate. Nope. That's not how it works. Okay, let's look at the last situation, and we kind of just touched on this, where your client does what we call a partial exchange. So in this situation, the client did a pretty good job. They sold for $500,000, they bought for $475,000, they reinvested all of their cash. They just got a really good deal on this property. They traded down just a little bit, not the end of the world. Just that small trade down results in a small tax bill. And a lot of people are okay with this because a lot of people see, well, geez, Leonard, what if I don't want to buy equal or greater in value? I found a perfect property and it's just a smidge short. That's fine. And some people don't even know that they can trade down. Some people think the only option is to buy exactly for equal or more. No. You can always do a partial exchange and trade down in value, but just know that the trade down difference is taxable. So in this case, we're going to pay about $8,000 in taxes. Make sense? This is a big one, and people get mad at me. They say, no, Leonard, I'm selling for $500,000, but my profit is $100,000. All I have to do is buy $100,000 worth of real estate. All I have to do is reinvest the profit. No, you don't. I've been doing this for 20 years. I think I know a little bit more than you do. No, that doesn't make sense. Why the heck did the government make me do that? And they get all mad at me and the government, and then they end up not doing an exchange. All right, so make sure that the clients know the rules. I'm happy to talk to angry clients and let them know that, hey, you're just yelling at me because I'm the messenger. It's the government's rules, not mine. All right, here's another thing people get mad at me about. Your client is going to sell a property, and you tell the client, this property we can list for $1 million. You bought it for $100,000, and look at that, we can now sell it for $1 million, but it's kind of ugly. So you got to go and you got to put some improvements into the property. The deck is falling down. Go fix the deck. Put some lipstick on this pig, and we'll sell it for a great price, but you got to make it look nice. So your client says, okay, I can do that. Your client spends $50,000 on fixing up the property, and you list it for $1 million, but guess what? Because you fixed it up so nice, you got it in contract for 1.1. Woohoo! Congratulations. Now your client's going to do an exchange because they have so much tax bill. And the first thing the client does is he calls me up and says, all right, I want to do an exchange, but I want my $50,000 back. What do you guys think? Your client just put $50,000 in. Can he sell the property and take $50,000 back? Well, he can do whatever he wants, but if he takes $50,000 out of the sale, it is taxable. Ladies and gentlemen, the first dollars that you take out from the sale are considered the profit dollars. All right? So we've got a bunch of money sitting in your house. The profit is the first dollars that sit on top. Your original investment is down here on the bottom. So if you take money out of this house, it's coming from the top first, and those dollars are taxable. So any cash you take out will be taxed. Just know that. Again, you can be mad at me for telling you that. It's the rules. But the good news is the $50,000 that your client put into the property, he gets credit for them, right? And the credit from a tax perspective is those dollars he put in are going to be considered expenses written off against rental income or capital improvements, which increase the basis. So these two things are great from a tax perspective, right? Because any expenses you get to write off against rental income, and any capital improvements will increase your basis. And when you do ultimately sell, your capital improvements will lower your tax bill. All right, so you do get credit for the $50,000 that you put in doing all this work. It's just you just can't pay yourself back with tax-free dollars. Does that make sense? And again, people get mad at me, but I'm just telling you the way it is. All right, let's move on. Let's talk about this. Closing costs. All right, do you remember back earlier in the presentation, I said that for 1031 exchange purposes, we always use your net sale price. And in order to get the net sale price, I'm going to take out your commissions and closing costs. Well, ladies and gentlemen, the commissions and closing costs that I can subtract are these: sale commission, title and escrow, recording fee, transfer taxes, and 1031 fees. Those are the most common ones. The ones that I cannot subtract are anything that recurs or anything that is related to the loan. So, what is related to the loan? Well, your mortgage interest, prepayment penalties, any prorated expenses like property taxes, utilities, homeowners. Okay, these things you cannot use to calculate your net sale price. And let me tell you why that's a big deal. I had a client selling a property for $21 million. They were paying off their loan early, and they had a $1 million prepayment penalty. My client wanted to take that out of the sale proceeds and then do an exchange on the remaining value of $20 million. I had to tell him, no, you can't do that because the mortgage prepayment penalty is not a cost that can be deducted from your sale price for 1031 purposes. In fact, if you use sale proceeds to pay this $1 million prepayment penalty, that will be considered boot because it is not an acceptable closing cost that can be paid with tax-free dollars. My client was furious, but because I'm such a good exchange guy, I walked him through the process. He understood the rules. He ended up paying that $1 million prepayment penalty out of his own pocket, because if he didn't and he used the sale proceeds to pay that $1 million, it would have been considered boot and he would have had a $300,000 tax bill. So yeah, my client was upset, but once he understood the consequences, he knew that it made good business sense to pay the prepayment penalty out of his own pocket instead of incurring a $300,000 tax bill. All right, so you need to know, ladies and gentlemen, what costs you can pay out of your sale proceeds and what costs you can't. And we always take a look at our closing costs for our clients and we say, okay, that's good, that's not. Does that make sense? All right, moving on here. We're going to have 9 minutes, and then I have to take my kids to lunch because just like all of you guys, I'm doing homeschooling. I've got a 6 and a 9-year-old, and they get angry at about noon if they don't get their PBJs. So I'm going to finish up here in about 9 minutes, all right? Identification nightmares. Ladies and gentlemen, this is what an identification letter looks like. You need to fill this out, and guess what? You need to fill it out on day 45 and no later. If you don't fill out the identification letter and submit it to us with your list of properties that you want to buy, you don't have an identification, a proper identification, you don't have an exchange. True story. We got an identification letter 2 days ago. And instead of putting the addresses of the properties they wanted to buy, they wrote, can't find property, senior citizens with diabetes, COVID-19, something, something, something. And we got it and we said, what the heck? We called them and they said, hey, we can't identify. We have health issues and we want to get an extension. And I said, you can't do that. The government doesn't allow for you just to make up your own extension. And they said, well, we're going to call the IRS. So they called the IRS and the IRS laughed at them and said, no, sorry, buddy. So day 45 is important. And on day 45, when you submit your identification letter, you need to do it in writing. You're going to sign this letter. And then if you get audited, they're going to subpoena our documents to make sure that the identification was submitted properly and on time. And if it's not, we get fined. All right, so they're going to go after you and us to make sure that you're doing these things properly. So make sure you fill out your identification letter on time and in accordance with the rules. All right, the rules for doing it, they're specified here. You can submit 3 properties of any value, or if you want to do more than 3 properties, you can, but the total value cannot exceed 200% of what you sold. All right, and we go over all the identification rules in our other advanced classes and our basic classes. So if you need to know more about these specific rules, shoot me an email and we'll send you specifics. All right, ladies and gentlemen, in this market, the lenders are overwhelmed. So a lot of your sellers might think, well, geez, I will serve as the lender and I will carry the note Let me tell you what, seller financing in a 1031 exchange is difficult. You're going to sell a property for $1 million. Your client's going to give you, your buyer's going to give you $200,000, and then you say, okay, well, I'll just carry the remaining $800,000, and the buyer will pay me over 10 years with interest. Well, that's fine. But if you're going to do an exchange, the only way to deal with seller financing in a 1031 exchange is to replace the value of this note with your own cash. All right, let me say that again. When you do an exchange, if you carry a note, you have to replace the note with your own cash. So you're going to sell the property, you're going to get $200,000, but then you're going to get a piece of paper that says, hey, your buyer owes you $800. Well, you can't put that piece of paper in the exchange account. You got to replace it with your own cash. So seller financing complicates a deal. If you have a seller that wants to self-finance and do an exchange, you've got me on speed dial. Pick up the phone, call your 1031 guy, and we'll see if it's going to work out for your client. All right, ladies and gentlemen, wow, I finished 5 minutes early. That gives me 5 minutes to answer all your burning questions, okay? So let's go to the top here. So Sergio says, yeah, Cheryl, when we talked about Cheryl who went to jail, remember her? She made a mistake because she didn't rent the property out for 2 years. If she would have done that, Cheryl could have avoided going to jail. Just use the property in an exchange as an exchange property. Steve says, what is the approximate percentage of tax a person will have to pay if they don't do an exchange? Great question, Steve. On average, in California, you're going to pay about 33%. Now, April's in Nevada. I'm going to say April, you're going to be around 28 to 30%. So it depends on what state you're in, but here in California, expect to pay about 33% in overall taxes between state and federal. All right. Now, Chris has a question about a trust. How can kids take the property out of the trust if it's irrevocable and mom and dad die? Mom and dad are dead, right? The trust says that the kids, Susie and Jimmy, inherit the property. So they're going to go down to their escrow with a copy of their trust, and they're going to have the escrow company record a deed in their name. Frank says the replacement property value has to be equal or greater in value. If there's a loan, does that loan have to be replaced? Yes. You're either going to get a good new loan for equal or greater, or you're going to add additional cash. So I don't know if I mentioned that. So when you do an exchange, if you have debt on the property you're selling, you're going to usually replace that debt with a new loan on the property you're buying, or you're going to add cash. All right, cash is king. So you don't have to get a new loan if you contribute additional cash out of your pocket. All right, last question. Frank says, can you list more than one property on your identification letter? Absolutely, right? You got the 3 property rule and the 200% rule, so there is absolutely ways to identify more than one property. All right, guys, you know what time it is right now? It's PB&J time, all right? My 6-year-old and my 9-year-old are going to be excited because it's lunchtime. Homeschooling is going to be done for about 30 minutes. So, ladies and gentlemen, that's it. I look forward to all of you becoming clients or working with us with your clients. Have a fantastic rest of your afternoon. If you have additional questions, which I think some of you do, shoot me an email. And as soon as we're done with lunch, we're going to get back to your emails. All right. Thank you all very much. Have a great day and look forward to working with you all soon.